Let's talk about Kevin versus Kevin. On one hand, we have Kevin O'Leary from Shark Tank, who is 66 years old and has a net worth of $400 million. And on the other hand, we have me, Kevin, who's 28 years old and has a net worth of $5 million. And they have different investing strategies. And in this video, I'm going to break down the differences and the disagreements between their investing strategies. So I'm not going to talk about their agreements, but I did want to acknowledge before I get into this that they do actually have some areas where they agree. For example, not using margin. Although me, Kevin, did use margin, but he did come out saying that he doesn't recommend using margin and he's backing off from using margin. But for the sake of this video, I want to highlight the differences between their strategies. Not to say that one is better than the other, because I think they're both great, but to show you the differences and to show you why you should use one over the other, or when you should use one over the other, because they have different goals. So let's see, and I'm using an extreme example of saying, can Kevin have a higher net worth of $400 million over the next 30 years? Not to say that for sure it's going to happen, but just to say, what would it take? And to exemplify and magnify the differences between here to really get through to you why you would use one strategy over the other, or when you would use one strategy over the other. So let's get into the video. The first disagreement that we're going to talk about is diversification. Kevin O'Leary, when he was critiquing Graham Stephan's portfolio, said that you should have no asset class over 20% of your portfolio. Well, we know that's not the case for me, Kevin. He has 55% of his assets in real estate. So why would Kevin O'Leary say that you should only have 20%? Well, he said in the video, so that when there's a downturn in one sector, whether it be stocks or real estate or bonds, you're not wiped out. You still have a lot of your net worth. Now, why would me, Kevin, have so much of his net worth into one asset class? Why would he have 55% in real estate? Why would he have probably the other 50% in Tesla? Well, it's because Kevin is focused on a different mission than Kevin O'Leary. See, Kevin O'Leary already has a $400 million net worth. Kevin O'Leary is not concerned with going to $500 million in net worth. Kevin just does not want to lose his money. And so by having a 20% diversification, you help protect your assets. Meet Kevin, on the other hand, is not worried about preserving his assets. He's concerned about growing his assets. And so it's a lot easier to grow your assets when you're specified and narrowed in on a few as opposed to spreading yourself too thin. Now, it's a lot easier to diversify if you have a high income. For example, if you're bringing in $1 million a year, like me, Kevin, is, you could actually probably follow this approach of 20% diversification and still grow pretty rapidly. But let's say you have a $50,000 income like the average person. Kevin O'Leary's strategy is going to make you grow very slowly. I mean, think about it. Most of us, we don't have a lot of extra income lying around when you're on a $50,000 salary to go ahead and, I'm going to buy a real estate property this year. I'm also going to invest my money in some stocks. I'm going to put some money in my 401k. I'm going to have some money sitting aside for cash. I'm also going to buy some gold and silver. I mean, if you're making $1 million a year, yeah, you can go ahead and do that. 100,000 here, 100,000 here, 100,000 there. But when you're making 50,000 a year, it's more like $100 here, $100 there, $100 there. You're spreading yourself too thin and you're not going to be able to grow. Or the other option is to pick maybe one or two of those asset classes and put all your money into those. And that's what me, Kevin, chose to do. And that is going to provide you a higher level of return. But it's also more risky. But me, Kevin's ideas behind why he's taking on those risks is because when you're starting off, you have nothing to lose, right? If you're starting with zero and then you go to 10,000 and then you lose it, you're back to zero. It wasn't that big of a loss. You're going to be able to get back to 10,000. If you're at Kevin O'Leary's 400 million and you go to zero, you're not going to be able to build that back at age 65 before you're, well, dead. So let's talk about the second disagreement. Money available. Kevin O'Leary, when he was critiquing Graham Stephan's portfolio, said that, hey, do you have all the money available to pay off all these debts if you had to for whatever reason? And Graham said yes. But how's that going to work for the average person? I mean, if you're looking to just get started off and you're saying, okay, I'm going to go buy an investment property, and maybe you're not even going to put like 5% down. You're actually going to put a decent chunk down. You're going to put 25% down on the property. So you got some initial equity, but are you going to have enough to pay that whole property off? Probably not. So if you're going to wait until you have all the cash to buy that property outright, you're going to be waiting for a long time, which means you're going to be missing out on the appreciation, the principal pay down. And so, yeah, you might end up having a property paid off free and clear, and it will be less stressful, but you're not going to achieve a $400 million net worth without using leverage. at least not as easily. And then he was also asked, which I was happy that Graham asked this question. After Kevin O'Leary said that, Kevin said, hey, I actually am at the point in my life where I don't even have debt anymore. And then Graham said, well, yeah, doesn't that make sense for you because you have a $400 million net worth? It doesn't make sense for you to go borrow debt at 2% so you can make 5% and gain on the spread and get 3%. It just doesn't make sense for you to be playing those little games. And then Kevin responded by saying, well, look, it's because people don't respect debt that they lost all of their money. And now Kevin O'Leary wasn't saying that these people were taking on too much debt or risky debt. The difference was that these people, instead of like Meet Kevin, who might take a HELOC out of his home to go buy another investment property, these people were taking that money out to go buy boats and cars and watches and cruises, and then they lost it all. So the difference here is Kevin might be using debt, but he's using debt to buy more assets, whereas these people were using debt to buy, well, butter, things that are just going to melt and go away and waste your money. So for somebody who is looking to build their wealth, it kind of makes sense. You're going to need to use some debt if you want to grow at a fast pace. If you want to get to $400 million, you're probably going to have to use debt at some point. And then the next disagreement was taxes versus losses. If you watch Meet Kevin's videos, you'll see that he's always talking about, I don't want to pay taxes and that's why I don't sell. Kevin O'Leary said it's better to sell than to take those losses. So what Kevin O'Leary is saying and what Meet Kevin's saying, Meet Kevin is saying, hey, if I've got $1 million in gain in my stock portfolio and I sell, I'm gonna have to pay about $500,000 in taxes. Well, Kevin O'Leary is saying, look, if the market goes down, you could potentially lose more than $500,000 in taxes. Your portfolio might go down to $300,000. And now you're wishing that you would have just taken your gains and had at least $500,000. Well, here's the difference, why Meet Kevin doesn't agree with that. If Meet Kevin was 66 years old, I think he would. But because he's 27 and he's investing in stocks that he really believes in for the long run and he's not speculating in these stocks, he doesn't care if his portfolio goes down from 1 million to 300,000. He's just gonna ride that out and wait for it to come back because he's got 30 years that he can use to wait to ride that out. So let's see what it would take for Kevin to go from a $5 million net worth to over 400 mil in the next 30 years. Now we know that Kevin just bought 11 properties this year. And if you watch his videos, he basically always tries to target a $100,000 boost of equity for each property that he buys. So if he bought 11, he probably just added $1 million to his net worth this year. Now he's at 6 mil, which was a 20% ROI just on real estate alone. And we know he's made a lot more through the Tesla stock as well. But we're not going to assume that he's going to probably keep getting this ROI every single year, although it's not unreasonable. He's almost like a Tesla stock right now. He might seem like he's at his peak, but Kevin's just getting started. He's not even at 1 million subscribers yet, and he's already making $1 million a year just in ad revenue. So we can probably assume that his revenue will keep growing and that he'll probably end up buying more and more properties. But I want to use a more conservative number for this calculator. We're going to go with 12%. And we're going to assume, right, Kevin's making $1 million a year just from ad revenue, but we know he's getting more income from other sources, from the little ads that he does on his video where he pitches life insurance and Webull. And we're also going to, we also realize that he has more money coming in from his courses, which is like almost another $1 million right there. So we're going to assume that he's going to invest $1 million a year, because we know he lives pretty frugal with his house and everything. If he's investing $1 million a year and he's starting with 6 mil in net worth and he's getting a 12% return every year, he'll end up with $423 million in net worth. And I'm rounding here. So that's what it would take for me, Kevin, to have a higher level of net worth than Kevin O'Leary by the time he's about the same age. I'm not saying that Meet Kevin will, and there obviously is a lot more risk involved with Meet Kevin's strategy here, as opposed to being as diversified as Kevin O'Leary. The point is not to say that this strategy is better, it's just to exemplify if your goal is to grow your net worth, well, Meet Kevin's approach might be more beneficial, it might help you get there a little bit faster. Whereas if you already have a pretty significant net worth and you're more concerned about losing that net worth, you want to follow Kevin O'Leary's advice. And to give you guys an example, this isn't just me who's saying this, right? Because I know you might be saying, why would I listen to you? I'm not a millionaire yet, I admit that. But let me give you advice from someone who is a millionaire, that's a third party in this situation, that also agrees with Meet Kevin's advice. Jeremy at Financial Education. If you listen to him, he says when you're just starting off and you're investing in stocks, don't go out there and buy an index fund or buy 30 stocks. Invest in one or two, pick one or two stocks. And then when you get to like a $100,000 net worth, then add a few more stocks to your portfolio. And really the most amount of stocks that you should have in your portfolio is about 15 or 20 stocks. You really shouldn't have more than that. So there's someone who is a millionaire and is telling you, look, you need to specify, you need to narrow down if you want to grow your net worth and you want to grow it fast. So again, the point of this video is really just to help clarify which strategy should you use for your current goals. If you guys know anyone who would benefit from this video, share it with them. If you liked it, give it a thumbs up and subscribe for more videos like this. See you next time.